Okay, now that we have the majority of people signed on, we can get going. Today, we're going to be hosting a 60-minute webinar talking about cash flow in the construction industry. We'll be talking to Hal Immelfarb, who is the founder of National Lien Bond and manages an attorney network nationwide that helps contractors, subcontractors, and material suppliers with their lien and with protecting and collecting on their receivables. We'll also be talking to Brad Warner with Whipley, which is an accounting firm as well as consulting firm for the construction industry, helping them navigate the challenges and newest litigation that's coming up. So without any further ado, I'll hand over the mic to do the quick introductions. Hal, why don't you go first?
All right, thank you very much, Anatoly. Hello, Brad, and welcome everybody from clients of Whipley and National Association of Home Builders and from MechanicsLien.com's website. We're looking forward today to showing you how we can help you improve your cash flow on every construction project and extend credit in a more secured basis. So the construction industry consists of many, many people on every project. And the typical situation, as all of you know, is you have an owner who's a developer, or it could be a city agency or some sort of corporation for their own use. And then you've got the GC or prime contractor, or today mainly referred to a lot of times as construction manager. Then you've got the subcontractors, various tiers, suppliers, and so on. So each one of you are likely in one or more of those relationships. What's important to understand is when you're extending credit in construction, you have the ability to improve your cash flow the closer you can get to the money. And so what we're going to be talking to you today about is how you can access the money and thereby get your cash flow protected. One of the most important things I think that most companies don't think too much about is how to audit a project credit. And we're going to be demonstrating to you some of those steps and how to do that. So when you're extending credit in construction, you know, who's your customer? Well, obviously your customer is the person you have the contract with. And that person is what is defined by law is being in privity of contract with you. So what you're going to find is that the Mechanic Lien Act really, and how you access your cash flow to a job is defined by exactly how a project is structured between the owner and his bank, and then between the owner and the general contractor, and then between the general contractor and the sub and the supplier, and so on, and where you fit into all that. So the interesting part of this is that most of you are not thinking about the project credit audit. And that's something that we've been thinking about for the last 40 years. And that's kind of like our specialty to help construction companies really understand how they can extend credit not only to their customer, but actually to the project itself. So in doing that, you need to understand that the basic situation would be that you would be able to get into a position where you have an understanding of the project. And why is that important to you? Because if you're selling your customer and the money somehow gets diverted, it's not coming to you. And in doing that, I think is very key to understand the history of the Mechanic Lien Act and what generally was required. So the first Mechanic Lien Act was actually created out of the formation of the Virginia and Maryland laws when they formed the District of Columbia for the United States in 1791. It's kind of an interesting history. But what it basically did, and let me read this to you because I think it'd be of interest, and give you an idea of what is the reasoning for it back then in 1791, and how you'll see it's so applicable till today. You'll say, well, nothing's really changed, has it? So in 1791, the act is called Undertaking to have a lien on the property. And it says, and for the encouragement of master builders to undertake the building and finishing houses within said city by securing them a just and effectual remedy for their advances and earnings. In other words, you're extending credit, and back in 1791, people extended credit, and the lien on the building or on the funds of the property, okay, would be a way for you to tie into your cash flow to secure it. So it says, be enacted that for all sums due and owing on written contracts for the building or any house in said city, or the brickwork or carpenters or joiners who work therein, the undertaker, workman employed by a person shall have a lien on the house and the ground upon which the same is erected, as well as for the materials found by him. And provided said written contract shall have been acknowledged before the commissioners, a justice of the peace will then take the property or the lien and record it in the office of the clerk for recording deeds therein. And then if you're not paid within 2 years, then you have to file suit. So those same processes that existed in 1791 exist today. And I think that when we do a project audit, and I'll kind of give you an example of one recently that we did, it's very interesting. We got a call from basically a person in Millwork who was working on the East Coast. And on the East Coast, it was actually a project located at what was formerly known as the Brooklyn Navy Yard. So our client wanted to improve his cash flow because he wasn't getting paid. And I think it was very good about that, in that he decided that he would extend credit to the project, but he wanted to protect his lien rights. And that particular project, the Brooklyn Navy Yard, was actually owned by the city of New York. So when he extends credit to a job owned by the city, how do you analyze that project credit and whether the job is even lienable or not? And we were able to show him how to do that in various steps. So I think that the area of improving your cash flow is very important by use of mechanical liens, and in doing that, I think that we have a situation where you'll hear more today later about how we can go ahead and provide you with the process and the security of understanding better what's needed for a project audit and so on. So when you're extending credit to your customer and to the project, in effect, you're becoming a secured creditor. So I'll be able to talk to you a little bit later about that. Right now, I'd like to turn the program over to Brad and Whiffley to have him give you a little idea of what a cash flow looks like today and some of the recent legislation that's been going on that'll help you as a contractor or supplier actually improve your money. And then we'll get back later to how you would actually take the steps and secure yourself on a project, and what steps are required to send notices, file claims, and some of the time periods for lawsuits and other remedies.
Thank you, Hal. Good afternoon, everybody. Brad Warner, partner with Whiffley. I lead our construction real estate practice here in the Chicago market. Two pieces of active legislation that I wanted to make everybody aware, and I'm not going to get super technical here, but I am going to share it with you because it has immediate tax implications and potential cash flow benefits. If we go back to, as I'm sure everybody's aware, we've had a couple of major pieces of stimulus legislation that have passed in the last 90 days. And one of those, if we go back to the Consolidation Appropriations Act, which President Trump signed into law back right after Christmas, December 27th, 2020, there was a provision within there that has immediate implications for home builders and anyone that is in the multifamily residential development game. So how that works is the section is called 45L. And what that's technical jargon for is the energy efficiency home credit. And going back to 2005, this was actually a temporary incentive provision that was added to the Internal Revenue Code back during the changes made during the Bush tax years. And over the years, this provision has repeatedly been expired, retroactively extended. As often is the case, this repeated itself again. It was scheduled to expire at the end of calendar year 2020. Ultimately, was extended through the 2021 year. And the key thing to keep in mind is how this works is it's an income tax credit to home builders and residential developers to invest in building more energy efficient properties. Now, the good news is if you're in my home state of Illinois here, most of the requirements are already kind of baked into most construction that you have to have energy efficient property. So how this ultimately plays out is it's a $2,000 credit per non-manufactured unit. Okay, so for every unit of energy efficient housing that you create, you could potentially qualify for a $2,000 credit. So and what some of the requirements are is it's not as simple as just needing to claim it for building a single family home. If you have a multifamily development that is no more than 3 floors above grade, so if you have below grade parking structure and then 3 floors on top of that, that development will also qualify. So in practical sense, in kind of real dollar sense, let's say you had a 3-story, 50-unit multifamily project, right? And you fully sold all the units in 2021. In that project, 100% of those units will qualify for the credit. Okay, so if you took this $2,000 times 50 units, you're talking $100,000 of tax credits that you can claim on your return in the year that you either fully lease it up or the year that you sell the unit. Now, the caveat here is that you have to have an independent third party certify that it is energy efficiency. So typically what we see is most third parties that can provide this service, and Whitfleet is one of those, is they'll typically charge a $300 to $400 per unit fee for the certification. So in our instance, if you had 50 units, you would have a $100,000 tax benefit. Net of a $15,000 fee, you'd get a net benefit of 85 grand. So in real sense, that's real tax dollars that a lot of people are potentially missing if you're not looking at that. The good news is with the way that this was codified in the law this year is even if you qualified for this in past years, you can go back and amend your tax return and claim it for those years. So just if it's not something that you've talked to your tax advisor about, the 45L credit, definitely have that on your checklist. And if they don't have good answers for that, I'd be happy to, at the end of this, Anatoly is going to share our contact information. I'd be happy to follow up with you on that. One other major immediate cash flow opportunity is related to the American Rescue Plan that President Biden signed into law earlier this month. And it massively changed the rules on qualification for the employee retention tax credit. Before, if you took PPP funds, you automatically were disqualified from the employee retention tax credit. With the changes of both the legislation that President Trump signed in December and with what President Biden signed here in March, the rules significantly changed. So you can actually qualify in both years for the both PPP and the employee retention tax credit. And the requirements for 2021 dropped significantly from 2020. So for 2020, just a high level reminder, you had to have a quarter where you had a 50% drop from 2019 in order to claim that credit. For 2021, that comes down to 20%. So if you have a calendar quarter, which if you're comparing to a calendar quarter in 2019, where you had a 20% drop in gross receipts, you can qualify for that credit. So two just really big tax benefits that if you're not actively talking to your advisors about, I would strongly recommend you do, because there's immediate cash flow implications for both. Al, I'll kick it back to you to kind of talk about some of the management of protecting and collecting with lien rights.
Right, and a quick question for you before Hal takes over. There was a question, does the tax credit roll down to subcontractors or only builder seller of the property?
Great question. It's typically qualified on the contractor and the developer's return. So typically not the sub. So if you're doing, okay, so if you're doing electrical work for the multifamily project, you're not going to qualify for it.
Okay.
But if you're a home, if you're a home builder or the
Hal,
ultimate,
why don't you? Sorry, go ahead. Sorry, Brad.
I was just going to say, if you're the home builder or the ultimate owner of the property, you will qualify for it.
Okay, very good.
Got it. Appreciate that.
I thank you, Brad.
Hal, now kind of handing it back to you to talk a little bit about, high level about lien rights and steps to take to protect those lien rights.
Well, I think as Brad mentioned regarding developers and owners, they basically structure their projects with their equity and their loans, and together the equity and the loan equals the cost of the project. So what we're talking today about is, of course, the more cash flow the developer has, the more cash flow he's going to be able to use to pay his subs and suppliers as these times get a little bit more difficult. So from a developer's perspective, I want you to understand that as a sub and supplier, because they basically put their equity and their loan together for the total project cost. Where developers get into trouble a little bit is when the cost of the project exceed more than the loan amount and the equity. That's where the change orders and things like that come in. So if the developer is not properly leveraged, there's a likelihood of a problem. He can also get into a problem where his market doesn't go well and his costs continue to go up. We have a situation right now where we're actually, our office is involved with probably the largest lien ever filed in the United States, almost 120 million, against a project in New York, which is the most beautiful skyscraper project you've ever seen. It's over by the, in Manhattan, by the High Line project. And it's just a beautiful project. In my discussions the other day, I'm representing somebody that only has a couple $100,000, not that it's only, it's a lot of money, and he's a supplier. His customer's got a $20 million lien, the subcontractor, and the GC, as I mentioned, has a $120 million lien. So when I talked to the developer's lawyer, I said to him, hey, you guys have these liens. Obviously, you're out of balance. What are you going to do to come to the table and work this out and get paid? So we're kind of having that discussion with them. When I'm looking at the developer, I'm explaining to him, basically, look, these liens, in our opinion, if we can do this right, are going to prime the mortgages, prime the equity, and then if you don't have any equity after paying us and the bank, you're not going to be in business. So the longer you let this last, particularly in a place like Manhattan, your high costs and expenses are going to wipe away your equity. So let's all sit down at the table and talk about this to get it resolved. And sure enough, we'll see what happens next week, but he's agreed to do that. So we were able to talk to the developer and work with the GC and try to sit down at the table and work things out. What are we working out? Getting paid. We're getting paid from the cash flow. So the lenders are going to have to move over, some of the construction lenders. New money's going to have to come in. That's a problem job. Your typical job, the loan provided by the lender and the equity of the project come together. The equity of the developer gets put in the project first, then the debt follows, and then the debt gets paid out either directly through the developer or the GC, or I prefer it, and this is where we start rating the projects and determining what steps are being put there for your protection, construction escrow. Because I like my suppliers and subs to get paid directly from the construction escrow. And I don't know how many of you, maybe you'll talk to us later in some of the questions and answer, you can tell us, but how many of you are taking these steps to look at the project, rate the project, to see how you do a really good credit audit, to see that you're going to be extending credit to your customer and to the project to get paid quicker and faster and more securely. So the way we do this is, of course, first of all, looking at the project data. So the project data would be who's the owner, who's the GC, who's the lender, and understanding it. For example, in the $100 million lien in New York by the High Line project in downtown Manhattan, we know every dollar that went into that job, and we know who the lenders are, what the equity is of the developer, and we're working with that tranche of people to try to get paid. The same thing happens on other jobs. We have a job like in Florida right now, and in Florida, on that particular job, we just got it settled. We represent a mechanical or electrical sub that did work for basically a GC developer who decided to go ahead and create a liquidated damage claim against my client for the full amount of the $700,000 my client was owed. Well, of course, we looked at the claim, we sat down with our client, we said, well, what are we going to do? They're claiming that you're late, and you can see that they're probably not being fairly objective. So when you're doing your project audit and your credit audit, you want to make sure you're following it in two different ways. In the beginning, you want to make sure that the lender's in place, the equity's in place, the project is ready to go, it's permitted, and the construction draws are coming and the money is flowing. The second time you want to do that, your audit's not completed, so the job is over with and you're paid, because you're really watching it. So like in this situation, we asked our client to sit down, we reviewed his change orders. We realized that there was 2 change orders given during the same period of time, which the developer, general contractor, decided to back charge us $700,000, which again was the amount of our retention and contract balance. So when we looked at the numbers and we realized on the change order, our client overlooked a simple fact. The parties through the project managers, which are binding on the general and on my client, the sub, signed an extension of time that provided not only additional money for the change order, but additional time. So under Florida law, when we audited those documents and we looked at them, we saw that the electrical mechanical contractor was entitled to additional time, and the owner's claim and the GC's claim for liquidated damages was actually misrepresented because the change orders conflicted by providing the extra time with their position that they try to take us on, and so on and so forth. So in Florida law, what you have is really the following. So what our client was required to do in Florida, he's a subcontractor in the situation, was he was required to give a notice to the project owner and to the GC and possibly to the lender if they're there. Now, why would he be required to provide a notice? Because the owner of the project, who has a contract with, in this case, the GC, it's kind of an in-house GC or related to them, GC, okay, they are directly in privity, but the sub is not. So Florida law requires, as do many states, about, I don't know, 28 of them, provide a preliminary notice within 45 days of first day of work. All of our clients are set up to work with local notice providers to make sure nationwide they're doing their notices correctly and with people locally. There are people today that are doing automated notices online, which are done by, I don't know, software programs. Well, good luck with that, because it's almost every time they've done it on more or less these complicated jobs, they're usually leaving out a step here or there that later on is being contested in court and is a problem. In this case, our client did their 45-day notice, they filed their lien, and we were just about ready to file our lawsuit. So the time period in Florida is 45 days from the beginning of the job, 90 days from the end to file your lien, and then file your suit within a year. And we sat down with the client and negotiated with the GC developers in-house counsel and said, look, you are aware, are you not, that Florida law requires you to pay when you're getting paid. Here it's a little bit convoluted because you're the GC and the developer. That doesn't excuse you. That probably made you doubly responsible for payment. And when you're doing that, the general contractor sat down with us, went to the table, and our client decided he didn't want to litigate, gave them a little bit of a break because he admitted he might have been a little late here or there, and they negotiated and worked it out. Typically, what's been happening on a lot of our jobs with many of our clients, which I'm a little surprised at, is after they file a lien, the general contractor or the owner come up and they're now bonding the liens to discharge them. And basically they're taking your money, if you're a supplier or sub, they're putting it into their pocket. They're not paying you, they're holding back. And like I just mentioned, this particular project with our mechanical electrical subcontractor in Florida, this was an apartment building, a private job, a very successful project. They were taking the entire money away. They did bond over the job and they basically using our client's money. Now, Florida law says, and we weren't able to threaten this directly, and we wouldn't have. But Florida law says if you take someone's money and you don't pay it in time and violate that trust, it's got significant consequences for you. I won't go into the details of it because I'll get in trouble by threatening somebody to do something that we would otherwise leave for other agencies to deal with. But Florida law is very strong to protect subs and suppliers to get paid, as are many states that have trust fund laws. In addition to trust fund laws, you also have prompt payment laws, which require the subs and suppliers to get paid. And the owner first requires the owner to pay the general within, let's say, 15 days. And then when the general gets paid, he has to pay the sub, who then has to pay the subs and suppliers within another 10 or 15 days. So those prompt payment laws are enforced in many states, and they're very valuable for you as a supplier or as a sub to get paid. So anyways, the gist of it is that when you're extending credit on every project you have, if you have the information and you've done your project credit audit up front and you know what the steps are in between, you're then able to get into a position where you can provide yourself with a level of security to get paid. And it's very important for you to be able to do that. And I think it's very helpful. So, in order for you to improve your cash flow as a sub or supplier, you really want to know that you're into a position by getting your company tied into the cash as quickly as possible. That's why I prefer to ask GCs and owners to create construction escrows and get you paid directly out of that. And basically the degree of how much your customer creditworthiness is will depend on how much effort you need to put into the project credit audit versus just extending credit to your customer. If you have somebody that's a good client of yours for many, many years, you know them to be creditworthy, then you're going to be more dependent on your relationship between you and your customer. And you may even want to be left in that relationship in an unsecured position, even though most construction companies, particularly in those states where there's notice of furnishing that are required early on in the beginning of a job, still go ahead and protect themselves to secure themselves not only for the customer, but put themselves into a strong lien position so you can get paid on the project. And most of your customers appreciate you doing that because then they feel that they're securing not only you, but them as well, because you're taking those kind of positions. So our firm is General Counsel nationwide. We've had 40 years of experience in looking at how every project that our clients ask us to look at, they fill out what's called a project data sheet. They send it in, and we basically provide the project credit audit for them, which outlines the steps, the risks of the job, and review many times for suppliers their credit agreements in the form of credit applications, and also the purchase order terms and conditions. For subcontractors, we do the same thing with subcontract agreements, and we go from there. So when you're trying to improve your credit and your cash flow, what you really run into is knowing what steps are required in the beginning of the project and during the project. Because as I just mentioned to you before, here was one of our clients, it could be you, it might have been, that's maybe why you're here today, I'm not sure. But I think that they basically know that the rights are being violated sometimes by the general contractor or the owner. And it's important to have a team of people available to you that understands both nationally and locally. Each one of our project credit audits are done in conjunction with our national office in Chicago and in conjunction with the local office where the project is. And so we provide you to be connected to these people to assist you in expressing a way to securitize your credit extensions to your customer and to the project. It could be a private job or a public job. The interesting thing about large private jobs and particularly public jobs is that all public jobs are typically bonded and provides you with additional protection. Also on commercial jobs. So I don't know why I've been spending a lot of time in Florida lately, in New York and California and Texas, particularly on many situations, and in Tennessee recently. We've got a couple of federal jobs we're working with in the Court of Claims and other places around the world, actually. What's happening is that the bonding companies are really like discharging liens with bonds and slowing down payment, which I've never seen the like of it with payment bonds. So we recently had a situation where another one of our clients had a job as a subcontractor where he made the mistake, which you could do too, so you gotta be careful about this, not to sign a contract with the GC that allows him to offset the job you're working on or any other job you may work with him on in the future. Because these general contractors bring you in to work with you, and they may have good intentions in the beginning, then they find out that in a certain project that you owe them more money on that job than they owe you, and then they want to offset the funds and try to go from there and take the money away from you on another job. So today we sent a letter to a bonding company and said, hey, we know that this job is bonded by you. We know that the general contractor is trying to offset this amount of money that's owed to our client on this job. We also know that the general contractor got paid on this job 100% by the owner, and he's not paying us. And you're taking the position you said earlier that you're going to bond, your bond allows you to stand in the shoes of the general contractor. And we said, no, that doesn't. You're the bonding company. You have an obligation to the owner on this job that my client's undisputedly owed money. On the other job where there's a complaint, you can't go in there and really offset the money of that job against us as the surety. The general contractor can try to do that, but the surety is an independent obligation. It can't. And sure enough, we found case law that showed that. So when you're working your claims and you're extending credit to improve your cash flow, it's always good to have, your organization depend on people like the people you're working with, or if you need help, we can assist you because we have a really great project credit audit program that if you haven't used it before, you'll see just how well that works by incorporating the liens and taking the risk of the contracts, putting it all together and providing you with some level of comfort. So when you run across these problems, you're prepared and you know how to handle them and deal with them. And really, today's world really requires, even though we're in litigation in many places every day, most of our work, and we've done, I think, around 9,000 different clients with like over $2 billion of collections already. And we have another 700 million or $1 billion present right now. So our nationwide network of attorneys and notice providers, along with our office as the general counsel to the group, really has a lot of experience together in many, many jurisdictions. And we have good relationships with lawyers and bonding companies nationwide. So the idea really is to help you take the steps, understand your internal decisions. Are you going to rely on the credit of the customer alone, which you can if they're very good creditworthy paying you, or do you need help also securing your receivables in addition to the customer by a project credit audit and something where you're looking at the project itself and how to get paid. Tomorrow morning, I have a conversation at 10 o'clock with a company actually from out of the country, a large manufacturer who's coming to the country from one of the Canadian provinces. And they're going to be doing a review on a very specific job that they're scratching their heads over because it's many, many millions of dollars, and they want to make sure they're going to get paid. So we're going to review all the things we've been talking about here a little bit and more. And what we basically get involved in looking at is looking the developer and the general contractor squarely in the eyes and saying to them, hey, if you don't pay us, we're going to lien the job and we're going to become the developer and have that property sold. That's what we like to do if you don't get us paid. And of course, we don't want to do that. We want to get paid and go on to the next job and have a nice relationship. But just so you know, we know how you're set up, who your people are, and who's lending to you. And in this particular actions that we take, everyone kind of gets to know each other and work things out. So one of the advantages of exercising a project credit audit is getting to know who's involved with the project in case something does develop and you have a dialogue and a discussion going forward. Because while we've been involved, in litigation, that has been forthcoming, and many of you may or may not have experienced this. In today's world with electronic discovery and the cost of litigation, it can exceed by far almost any effort of legal work that goes in, but sometimes it's necessary, and we try to get it done quickly and efficiently. So most cases are settled, 99%, 98 to 99% of them. And the idea is take the steps up front, manage the process as you go along, and work in that direction to get paid.
Got it. Thank you, Hal. Wanted to hand it over to Brad, and one more time remind everyone, please feel free to ask questions through the Q&A or through the chat. We'll be sure to do about a 10 minutes kind of roundup towards the end to address any questions. And now I'm going to hand it off to Brad to talk about 6 specific steps to manage cash flow.
Thank you, Anatoly. And thank you, Hal, for that intro on the importance of securing your receivables. Right. Sometimes we forget that without the proper remedies that Hal just detailed, a receivable can easily be unsecured, right, and just becomes no different than any typical vendor where if times are stressed. And what I kind of want to focus on are just some strategies that we can be using to conserve cash and increase cash flow. And if we look at just the general state of the construction economy right now, right, we have a lot of external threats, whether it's input costs, the price of lumber, labor. I think everyone's bullish about the vaccine rollouts across the country. But there's still a lot of uncertainty out there, and one general trend we've seen through almost any organization that's posting data on this subject is there's a lot of backlog pinch right now. Back in according to the Associated Builders and Contractors, December's 2020 backlog was 1.5 months lower than in December 2019, right? So will contractors have work they need in 2021 to meet their obligations, from whether it's payroll to any debt they have? Now is the time to be thinking about how we conserve more cash and increase cash flow. And if you think about the very nature of our industry, right, the construction industry, it's inherently inconsistent in cash flow because we're a cyclical business, right? Which only makes cash management all the more critical. So the first item I'll throw out there, and it probably sounds incredibly obvious, but just an important time to just take stock of it is, although earlier I referenced the Consolidated Appropriations Act from January, and the American Rescue Plan that Biden signed into law earlier this month. We had the Paycheck Protection Program. We had the CARES Act from last year. All those provided liquidity, right? So hopefully all of you on the line either were able to partake in some of those stimulus benefits to keep your companies afloat. But in addition to all of that, we got to really ensure that our traditional lines of credit, our loans with our banks, are in place, and determine whether they're going to be whether they have the necessary and correct banking relationships. So making sure that we have strong banking relationships, and we're engaging in active dialogue about especially if we're in a time with uncertainty where we think cash or financial position may deteriorate. I don't know that we've seen it yet, but it's entirely possible that banks get a little tighter with their credit requirements. And getting ahead of that before that comes could be, it prevents you from, your banks don't want to be blindsided, just like any of your other creditors. So making sure we're having consistent communication, open dialogue, is incredibly valuable. And sometimes what we find is, do we have the variety of banking relationships, right? So should we have a mix? Should we have a community bank and a larger financial institution to provide you with different ways of financing and securing your collateral? This kind of really played out with folks that felt like they got pushed to the back of the line on the PPP program, right? Where if you'd had a couple of banking relationships, could that have been a little bit expedited? So that's kind of the first step. Strengthen our banking relationships, taking stock, making sure we're on the same page with one of our primary sources of capital, frankly. Step two, and maybe I'm not saying anything that anyone hasn't even ever thought of, but whether they actually are implementing it in practice, is creating solid cash flow projections. It's typically not a process. We see a lot of small businesses baking into their daily business hygiene, but a big focus in 2021 is going to be on good cash conservation behaviors. And hard to do that if we're not creating a solid cash flow projection, right? And that process can involve as simple as just looking at your expenses, understanding what you need, what you don't need, putting a solid methodology in place to forecast cash over a longer period, right? So I mean, ideally we're doing it at least in a 12-month, but even looking out 24, 36, 48, 60 months, and frankly doing scenario planning, right? That's been a huge topic of conversation with a number of my clients is if this happens, what does that mean for us financially? So kind of forecasting doomsday scenarios, forecasting, super high growth scenarios. And just kind of plotting those out so you can know how aggressive your actions need to be on a go forward basis and what actions you need to take depending on which scenario you encounter. So, a strong, if you can bake that into your internal finance team's processes, that's one that would have my strongest recommendation. And then also just kind of looking at your existing jobs and their probability of payment, and anticipating some of the issues that Hal just if you're expecting that there's going to be collectible concerns, or making sure that you're staying ahead of being proactive versus reactive on that. So again, step 2, just creating a solid cash flow projection. Step 3, revisiting kind of your discounting strategy and your credit standards and your AR terms. Cash going out is just as important as cash coming in. You want your payables to be as long as possible, and you want your accounts receivable being turned into cash as quick as possible, right? And for AP, you want to make sure that you're tracking payables. You want to make sure you're tracking their due dates if there's discount terms. And you really want to place them in those 2 categories, right? Like what has to be paid, what can wait. Working with your bank to renegotiate when you make payments or for how much. During COVID, that's been something banks have been, I don't want to use the word generous, but have been working with clients on, if there needs to be a payment deferral. Now's a good time to talk about that. If you're going to anticipate future issues, you're more likely to get compliance from your bank if you're being upfront and transparent versus springing it on them last second. With some of your inputs and construction materials, can you negotiate a discount? Can you find suppliers willing to give you good financing and payment terms? If you're using subs, negotiating payment terms so you don't necessarily have to pay them as timely as usual. And also, I know this seems basic, but finding out which one of your vendors accept credit cards, right? Nothing will get you an easier 30-day payment extension than being able to charge it and buy that extra 30 days of interest-free cash. So making sure you're having those discussions with your vendors. On the AR side, making sure that we have an employee that's following up on collections. You'd be surprised at how many small businesses just don't have that process in place, right? Where, if only somebody was calling on the due date of the bill and confirming items that, Hal mentioned, whether there's a lien release or if insurance certifications are a holdup, just as simple as just following up on that on a timely basis can really accelerate the collections process. And finally, if you've got an outstanding retention balance, following up, just making sure they're outstanding. It might really be an easier fix than you think. Sometimes it's just as simple as having good, open communication. I think as we look to my 4th item on my list here, looking at labor costs and taxes, we referenced some of those tax provisions of the recent relief bills that if you're not talking to your advisors, please do. There's a lot of really good nuggets in there that are helpful for the construction industry. But from a real practical standpoint, like failing to remit a payroll tax is a major issue, right? We don't want to be so busy working on the business we forget some of our blocking and tackling on the compliance side. But you also want to make sure that we're careful not to overpay on unemployment taxes. So performing an audit of all the states you work in and making sure you're consistent with each state's requirements. Make sure you're paying the correct unemployment tax and monitoring the right unemployment that you're owed. Looking at salaries and benefits, something we're noticing this year is, whether it's your health insurance plan or your 401k plan, if you have a retirement benefit plan, making sure you're doing an updated assessment on that, right? I'm sure as everybody's kind of going through their insurance renewal, they're really getting slammed with some really high premium increases. One area that you can potentially look at making that up is, and most outside vendors will do this for free, is just kind of doing a competitive analysis of whether your 401k plan or whatever your retirement plan is, whether it's competitive fee-wise, right? So if you instituted that plan, say 5-10 years ago, and you've never really gone back and kind of assessed, okay, is this still competitive? Now's a really, really good time to do that. And most outside parties they'll come in and they'll do a benchmarking for you for free. Looking at looking at if you've got little things like an employer match where you're making it every month, can you kind of turn that off, and then retroactively you can match it at a later date, right? Little strategies like that you can look at. Looking at salaries too, whether it's cutting a percentage of compensation that can help conserve cash, putting folks on more of a part-time schedule. Frankly, we have a lot of people doing kind of an assessment of whether some of their back office functions, whether it makes sense to outsource it because they're not really getting the full utilization of that employee. We're seeing a lot of that in the market is, whether you don't have a controller or you don't have a CFO, but there's some functions of that you need. But rather than spending, $250,000 all in on having a full-time employee that you can't necessarily leverage fully in those functions, whether it makes sense to outsource that function. We're seeing a lot of clients make some serious overhead cuts in that way. And then just knowing some of your other costs, right? Whether it's, adjusting your bidding to help increase cash flow, whether you're committing to projects that are kind of outside your wheelhouse or, aren't, now's not necessarily the environment where you want to be taking on projects that you're not used to be able to hit the pitch out of the park, right? So having, understanding, and having good evaluation processes for, at whatever, if you're going into new work or you're taking on bigger projects at lower margins, really having a kind of a red team approach of really looking at that and saying, hey, is this really something that we're in a place to be taking on right now? Some other ways we're seeing people, save some costs, frankly, is on the technology side, right? The construction real estate industry has always been a space that if you compared it to financial institutions, healthcare, manufacturing and distribution, it's been a space that has really lagged behind the rest of the industries in technology implementation. I think COVID was a real kick in the butt for a lot of people, especially with a remote work environment. So understanding, are there tools that we can use, whether it's, a bill.com for AR and AP and automating some of that, right? All these functions where maybe you had a full-time employee before, but now, are there efficiency gains? Are there productivity gains from utilizing some of these technology tools? Really understanding, taking a fresh look at your tech stack and just making sure that, okay, is this supporting us being, managed effectively financially? And step 6, and how kind of went down this path. And again, I can't recommend this enough. This is not a plea for us to try to get you to pay us more for services, right? We're not sitting here saying, hey, look at all the wonderful services we can do for you. It's more, don't be afraid to engage outside experts to help you fix some of these processes. Because if ultimately it puts real cash back in the company, I know most of us that work with outside advisors, good advice is worth its weight in gold, right? So not being afraid to pick up the phone, talk to your trusted business advisors, and just make sure that you're staying on top of all these things. Because when we all get busy, that's when stuff starts to kind of slip through our fingers, and we're not managing risk properly. Which frankly, people that are managing risk effectively tend to be really healthy cash flow wise. So again, just 6 kind of easy steps to think about. I know that probably sounds like basic business hygiene, but you'd be surprised how many times people just actively just aren't prioritizing those things. So, thank you, Brad.
One thing I want to mention, it's kind of I want to put a little humor in this because I get too serious sometimes, But a friend of mine was telling me a story that last summer he took his banker out on a Gray Lake sailboat in Lake Michigan. And Lake Michigan get pretty rougher than some of the northeasters on the northeast coast, or some of the storms around the coast in Florida, in California, and other places, in Carolinas, in the hurricane. So the banker went out with his contractor client, and he basically, a storm came up, and the banker fell overboard, and the contractors kind of look at him holding a life preserver, and he said, "Hey, I don't know if you could swim or not, so I wanted to just ask you, do you want to float alone or not?" And the banker started, "Hey, this is a heck of a time to talk about business. Okay, just throw me that life preserver." So, kind of what Brad was talking about basically is, when we do these project credit audits and we do the things Brad's talking about, he's right. Managing risk is really what it's all about. And your 30, 60, 90 accounts receivable, that tells your whole story. And that describes your cash flow and the things that you're doing. So, one of the things that we're going to offer to everybody on the program today for a limited time is from a free project credit audit. Try it out, whether you have one job or you want us to look at the 30, 60, 90 receivable sheet with you, if you're a national company or somebody that wants to do it like that. And without that audit, you really can't be sure sometimes of what the risk and the holes are that you have and where the security comes from. So we can kind of look at that, and we can sometimes do it together as with your accountant, Brad and I, and be able to help you take a quick look at that particular situation. And whether you have one particular problem that you've got, or you just want to look at the receivables. So when you go to that banker, like Brad's talking about, and try to get there, and I know a lot of my clients are doing that now, you want to be able to tell him your receivables are secured, and this is the process that we do it in. And we've had the project credit audit, and we basically have our accountants and our lawyers feeling that we've done everything we can to update our systems. So looking forward to helping everybody that needs a little assistance in that area, and work with you and your accountants and lawyers on this special expertise that we have.
Hal, can you talk a little bit more about just national lien and bond as a whole, how you manage the process, how you have the network of the nationwide attorneys to be able to represent in the various states where contractors might have problems?
What we basically have done is created effectively a very large law firm, but it's not a law firm, it's a legal network. And we use it very efficiently. So if you have a problem and you're extending credit nationwide or locally, we work with you on that particular situation. And again, we protect your receivables, and we stay there from beginning to end to make sure that you get paid. And how you do it is you fill out, basically, it's called a claim data sheet, but effectively it's the data for a project credit audit. So before you sell or after you sell, people fill these sheets out and send them in. Some of our clients do their notices themselves. Some of them depend on us for everything. We work and customize with you what works for you the best. Typically, somebody that's located in one or a few states, it has a pretty good handle on mechanic lien laws. And likewise, when you go national, and I've been doing this over 40 years, and I've learned things every day that you just couldn't believe. Some of the things are practical, like how do you get, in a time of COVID, a satisfaction lien released in Kings County, which is Bronx, New York, when nobody will let you in the door, okay, or talk to you. Well, Gary in Window 11 became my best friend after I hunted him down with a few process servers and people to find it. So there's a lot of really good people out there that we work with to help you get paid. And we basically use our national office, so we think globally and basically nationally on your behalf, but we can't do it ourselves. So we rely on our attorneys in every state, in private and public construction, and our notice providers around the country. We have the best notice providers in the country, and we use companies like CNS on the West Coast to do all of our notices, BNS in the in Florida, and Upper Florida. There's another company, another CNS up there, and other companies around the country. So the notice service providers we work with have the 20-some states that require the notices, and you work with them, with us as a team, and get your self-protected. So we just want you to secure receivables, get paid, and make sure that when you go to the bank, like Brad's talking about, your banker is going to appreciate that you're selling on an extended credit basis, which is secured versus unsecured. And when you get tested for that, you'll appreciate having that kind of security behind you.
Sorry, I was on mute. And Brad, it sounds like you guys as an accounting firm do so much more than accounting, between the audit of current expenses, which falls into accounting, but then also looking at insurance expenses, looking at employee engagement, looking at technology stacks. Kind of talk a little bit more about how Wipfli plays a role in the construction industry and with your clients.
Yeah, sure. Well, for those of you that aren't familiar with Wipfli, we were recently named Construction Executives #4 accounting firm in the country for contractors. We have 45 offices across the country, from Portland, Maine to Oakland, California. And exactly right, to Anatoly's point, the traditional CPA, accounting, financial statement piece, yeah, we can handle that. But that's the stuff you need because you got to have it, right? You got to have that stuff. But it's the business advice, whether it's on business strategy, navigating people, processes, technology. That's the kind of stuff that we've got the capabilities to handle. And it can be things as far as, Hal might be getting brought in when you've kind of got a problem and you've got to figure out how to get out of that problem. We can definitely help on the front end of that, is, helping you make sure that you're understanding how you're reviewing your contracts and, avoiding potential litigation. We can get brought in as litigation support experts and things of that nature. So some of the non-traditional stuff you wouldn't associate with a CPA firm, we have the ability to, listen to your business problem and figure out if we're not the solution, point you towards somebody that can.
Got it. Thank you. Hal, back to you. There's a quick question for you from Ruth. Common language in our subcontractor agreement is subcontractors' right to any and all payments or performance under this agreement is contingent upon contractor's receipt of payment from the owner. In this scenario, if the owner pays late, do you have any advice on this situation? Do we request a change order for finance fees?
Ruth, that's a question that we deal with every day, which are basically the onerous general contractor terms that basically put all the risk on the subcontractor, and how do we fight that back? So yesterday I was negotiating a term for a subcontract, and they were talking about these type of clauses. So you can never say no to a general contractor that you're going to completely delete his clause, because they like to use their form. So I've taught many years ago by a concrete subcontractor out of Georgia on a project in Knoxville on the University of Tennessee law library, that basically he would take the clause like you're mentioning, and he would write at the end of it, okay, except for until a reasonable period of time is expired. Or he would write on there, nothing in this provision impacts my lien and bond claim laws, to your point. So what you basically need to do is kind of like go along with the fact that he wants to have some protection for himself, but see if he'll be reasonable with you. If he's not going to be reasonable, it's kind of giving you a heads up. That's the kind of project that a project credit audit would maybe, avoid a problem with, because you may not want to do that job if it's not properly secured. And if you have that risk, ask him what he's done to protect you, because what are these general contractors? I mean, not they don't do anything, but the money doesn't belong to them. The bulk of the money, the vast majority of the money, it's your money as subcontractors together. So, one of the things we're going to be working with this year, kind of what Brad was talking about, this pandemic has taught us all kind of a lesson, how to work remote, but yet get things done. Well, on a construction job, talking to each other is important. So we're going to be looking for ways to start a construction job, for example. Maybe some of you can help kick this process off. Start a construction job, invite other subs to share the data with you. So these project credit audits can be a little bit expensive, and they're mainly used for people that are doing over a couple $100,000 worth of credit extension. But it would be beneficial whether you're doing 10, 20, 30,000 or $500,000 or a couple of million, and they're expensive. So why don't we come up with the idea in the industry? The thought is, and I want to talk to the National Association of Home Builders and get the home builders, which are usually, people that want to do the right by the subs and suppliers, because without them, nothing gets done. And learn how we can share that information up front, so we know we're less at risk later on. And these onerous clauses, as far as I'm concerned, they should be thrown out and neutralized. But you've got to play the game with them a little bit by just making little changes that help you. Because in reality, they don't pay you, just leave the job. If you did it right, go after the bond claim, call the owner up. That's what we're doing these days. Okay. Hey, I got to liquidate damages. Hey, how much were they really? Okay. So that kind of communication and transparency is going to become more important as time goes on, because people are getting desperate, as Brad said.
And Hal, a quick follow-up question also from Ruth. On our contracts typically state that the performance bond is optional as a subcontractor. Do I want to take out a bond or not? I'm not super clear on the role the performance bond plays. Can you expound?
So if you're an owner of a property and it's a large commercial project, I remember like in Chicago when the Walgreens buildings were going up, the general contractor has to be bonded in order to do the work. Bonding means that you basically have the financial ability to show the owner that you're creditworthy and that you can provide a bond. A bond in a construction contract for between a general and owner or between a sub and a general, they're the same. They're twins to each other. They're called a performance bond and a payment bond. A performance bond means, let's say, for example, in the Ruth's question, that you're let's say a concrete contractor, okay? And you're working directly with the owner and you're building a building that could be, 5 stories high or whatever, something maybe it would be small or smaller that qualify for some of the tax credits that Brad was talking about. And you're working directly for the owner as a subcontractor, or you're working for a general, or you're working for a construction manager. They're looking to make sure that their subs can perform. And if they can't perform, then they want to have the ability to go to the bonding company and ask them to perform for them. That's a performance bond. I, the principal of the bond, the person that's taking the bond out, hereby have my bonding company represent to you. If I don't perform, they will perform for me. That's why it's called performance bond. In every government contract, you can't do a government contract without a performance bond. And in addition to performing work, you have to perform your payment obligations, but the performance bond is for work. When there's a default or a claim of a default, the payment bond is there for you to protect yourself when you don't get paid or you owe somebody money. So if you're a sub and you're buying concrete for the job, and you don't pay the ready-mix supplier, and he makes a bond claim, he makes a lien claim, then the bonding company will step in and see that even though the work was 100% performed, but the bond claim is being made by the supplier to the subcontractor in this case, or to the general contractor, where basically they go ahead and don't get paid. So the bonding company's gonna have to make a bond claim. I just got through doing one, actually when I was on recess with you guys a few minutes ago, back to that situation where the bonding company's claiming that they're gonna stand in the shoes of the general contractor and won't pay my client, even though my client did the work, the general contractor got paid for him, the owner paid the general contractor. It's 100% clear because they're claiming on another job that they're going to be able to offset it. That's a little technical, but that's the same situation, Ruth, that would be happening. If you're giving a bond, you're giving a bond showing you can perform and you can pay your bills, basically. And if you don't, the third party, the surety, stands in. And that's why it's a special relationship, because the surety is not a general, they're not an owner, they're a bonding company. And a whole set of laws apply to them. And sometimes hard to believe how these laws work, but they do, and they've been around for a long time.
Fantastic. Thank you, Hal, and thank you everyone for attending. Just wanted to wrap up by saying that we're going to circulate a copy, recording of this webinar along with Brad and Hal's contact information. Wanted to thank Hal and Brad for taking the time today to share with the industry at large kind of the past and present legislation, as well as upcoming steps that can be taken to safeguard cash flow. So thank you, Hal. Thank you, Brad.
Thank you, everybody.
All right, everybody have a good day.
Have a nice day.
Thank you.